What's up guys, and welcome back to Crypto Guy News YouTube channel. And today we're going to see the reversal candlesticks part 4, and this is a complete guide to candlestick patterns crash course, that is part 5. In the last episode we learned about different types of reversal candlesticks and how to interpret them. A reversal of direction of a trend happens slowly after going through different stages, which we are going to continue in this video. We are going to start with the Tweezer Top Pattern. It is called tweezer because it is similar and acts like the two prongs of a tweezer. The tweezer top forms following an uptrend or near resistance levels, and it consists of two candles, and the first one is medium or long green candle, and the second one is a shorter red candle that is in the low to high range of the first candle, and the high of this candle is equal to the high of the first candle. The high here is just the same, as you can see. In this pattern, the focus is on the highs, and the second candle can open above or below the first candle open, not necessarily in the same level. The highs can be composed of bodies or shadows. The point is that we must have matching highs, so the highs can be either body, for example in the case of Marubozu, like we saw the Marubozu in the first episode, or top of the upper shadow in a candle and this matching highs. So it can be a Marubozu or a candle of matching highs. Shows a resistance level, and this matching highs here shows a resistance level that is establishing and gives the possibility that a reversal may happen. So when this happens, it shows a possibility of a reversal. Another opposite to that one is a tweezer bottom pattern. It forms following a decline or near support levels. The first candle is medium to long red candle, and the second one is a shorter green candle that is in the low of to high range of the first candle, and its low is equal to the low of the first candle. So the low of this candle is equal to the low of this candle, and the high range of the first candle. This pattern, the focus is on the lows, so the second candle can open above or below the first candle open. The lows of two candles must be equal, showing that a support level is establishing and that this is a downtrend, and this downtrend is weakening, and there is a possibility of reversal. It becomes stronger and more significant when they also part of each other's pattern, like the Harami cross. We saw the Harami cross in the last episode with the same highs, or a hanging man, or a shooting star with the matching highs, or after a long red candle. In these cases, the probability of a reversal is higher. So the Harami cross and the hanging man, shooting star, we saw them in the last episode, the first episode, so you can just check them, and then you can understand what we mean when we say that it becomes stronger and more significant when they are part of pattern like the other ones that we have mentioned here. So another one is a matching low pattern. It forms in the bottom of a following a decline. The pattern is made of two candles. The first candle is a medium to long red candle, and the second is also red candle, shorter than the first candle, that is open in the body of the first candle, meaning that the second candle opens with a gap above the first candle close. So it opens above the first candle close, and which at first shows that a sudden high buying pressure, but the seller step in and take the control of the price and push the price down, and the candle closes at the price level that the first candle was closed. It's open here and is closed here like the first candle. If the second candle has a lower shadow, the shadow should not go lower than the first candle lower body. This pattern shows that the pair are not strong enough to go lower, and this support level is establishing and gives the possibility that this is a downtrend, and its downtrend is weakening, and we may have a reversal to an uptrend like you see here. So they started like this, the bear market, and then the bear was weakening here, and then it shows a reversal may happen anytime soon after this. The next one is the matching high pattern. Matching high pattern is opposite to the matching low pattern, and it forms in the top following an uptrend or resistance level. First candle is medium to long green candle, and the second candle is a green shorter candle than the first candle open, and is open in the body of the first candle. In other words, it opens with the gap below the first candle closed. It shows a sudden selling pressure, but the bulls take again the control and push the price up, and the candle closes at a level that the first candle was closed. It shows that the buyers are not strong enough to let the price go higher, and a resistance level is establishing. The second candle has an upper shadow, should not go higher than the first candle upper shadow. This first candle upper shadow should not go higher than the first candle upper shadow, and we see that the next candle, which is the second candle, is within the body of the first candle here. So we are going to see the matching high pattern. Matching high pattern is just the opposite of matching low patterns, and it forms in the top following an uptrend or near resistance level. The first candle is a medium to long red-green candle, and the second candle is also green candle, shorter than the first candle. Bullish stick sandwich. It forms in the bottom following a decline or near support levels. The first candle is a medium to long red candle, and the second candle opens with a gap above the first candle close, and this candle closes above the first candle. This shows that there is a sudden shift from selling pressure to buying pressure. The third candle, which is the red one, also opens with a gap above the second candle. So there is also a gap here above the second candle. But the bears step in and take control again, and the price pushed approximately at the level where the first candle was closed. Okay, and its lower shadow goes lower than the first candle shadow. So we see that the shadow also goes lower than this first and than this shadow. This shows that the support level is establishing, and the bears are not able to break this level. Okay, that's why we see that the bears were going on well, and then they didn't break this level here, and when they started again, then we see that there is a reversal of an uptrend, and we're told that this shows that a support level is establishing, and the bears are not able to break this level, and they are losing the strength, and this gives a possibility that this downtrend is weakening, and we may have a reversal. And as we can see here, we have a reversal of going up instead of going down like the previous session. The bearish stick sandwich. This forms following an advanced or near resistance level. The first candle is a medium to long green candle that shows selling pressure. The second candle opens with a gap below the first candle, and it closes below the first candle open. So this is the open of the first candle, and this one is the close of this second candle, and it shows that we have a change from buying pressure to a sudden selling pressure. The third candle, which is the green one, opens with a gap below the second candle. It opens with a gap below this candle, but the buyers again take control and push the price up. So the buyers are also pushing the price up, and the candle closes at the level of the first candle closed, and its upper shadow is also not higher than the first candle upper shadow. This formation shows that the resistance level is establishing, and the bulls are not able to break this level, which indicates that the upper trend is weakening. This upper trend here is weakening, and the direction of the price may change anytime. With another candlestick pattern, we see it's called three white soldiers. This is a bullish reversal pattern, and it forms in the bottom following a downtrend or near support levels. In this pattern, there are three candles, and three of them are long green candles following a downtrend. The first candle after that, the second candle opens with a gap below the first candle, and the price may continue declining, but the bulls again take control and push the price up. Okay, higher than the first candle close, than this candle close, but this time also the players don't have the ability to take control of the price, and the bulls push the price up higher than this second candle close. This pattern shows that the downtrend is seriously vulnerable, and the buying pressure is stronger than the selling pressure, and gives a possibility of a reversal. So we see that after this downtrend, and after we saw the 3-3 white soldiers pattern, we see that there is a reversal of a direction. So the potential direction changes from downtrend to uptrend. The three black cross pattern. The three black cross pattern is exactly similar to the three white soldiers as we have seen in the previous slide, but in the opposite direction. Here the pattern forms in the top following an advanced or near resistance level. The first candle is long and red, which shows the selling pressure somewhere in the top. The next candle opened with a gap above the first candle close. As you can see, the first candle closed here and this one just opens here, but no chance for the bulls, and the bears push the price lower significantly and the candle closes below the first candle close. Okay, the third candle again opens with a gap above the second candle close, but this time also the bulls are not able to take the control and the bears push the price down and the candles closes below the second candle close. This pattern shows selling pressure is much higher than the buying pressure, and this indicates that that is an uptrend may end. There is a possibility of a reversal. So we see this was a downtrend, uptrend, and after this three black cross pattern, we see that there is a reversal of the pattern. The two cross pattern. This is a bearish reversal pattern, which means it forms in the top following an advanced or near resistance level. The first candle is a medium to long green candle, and the second candle opens with a considerable gap above the first candle close. But sellers don't allow the buyers to go higher and take control of the price and push the price down, and the candle closes above the first candle close. We see a gap between the two candles, and the third candle is a long red candle and it opens with a gap in the body of the previous candle. But again, the bulls are not able to take control of the price and the bears aggressively push the price down, fill the gap, and candle closes in the body of the first candle. And this pattern shows a very high selling pressure and gives a possibility that an uptrend may end and a reversal is possibly happening. Upside gap, two cross pattern. This is a bearish reversal pattern and it forms in the top of the first candle. Similarly, a medium to long green candle, and the second candle, like the two cross pattern as we've seen in the previous slide, opens with a considerable gap, and candle is a long red candle that is above the first candle and is also closes above the first candle close, and we see a gap between the two bodies. So this is the gap between the green candle and the red candle. But here the third candle opens with a gap above the second candle close. In the other words, the third candle engulfs the body of the second candle. Okay, so we see here that this one engulfs the body of this candle. And this indicates that we have a very high selling pressure and there is a possibility of a reversal. In this pattern, it's a little weaker because the gap is not filled yet, and the gap may play as a support level but still shows a very high selling pressure, and there is a possibility that the uptrend may end and we see a change in direction of a price. Like we see here, after this trend looks like it was going up, and then we see a directional change, direction of a trend that is changing here. The three inside up pattern. This is a bullish reversal pattern, which means it forms in the bottom following a decline or near support levels. The first candle is a medium to long red candle, okay, and it shows selling pressure. And after that we have a second short green candle. Okay, this is the short green candle that opens and closes in the body of the first candle. It opens and closes in the body of this first candle and is totally included in the body of the first candle. The third candle, which is this one here, opens with a gap below the first candle close. At that, you may think that the bears are back and the prices is going to decline again, but the bulls take control of the price and become the winner of the session. The result is a greener candle and closes above the first candle open, above the first candle high, and this shows a very high buying pressure and gives the possibility that we may see a change in the directional trend. As you can see here, there is a change of this downtrend to uptrend. In the second candle is a small pattern becomes an extension of a bullish harami, and by having the third candle we'll have a very significant possibility of a reversal. So after this green candle and after the next green candle here, we see that the pattern is going up, so a reversal of the pattern. Another one is the 3 inside down pattern. It is exactly like 3 inside up, but is in the opposite direction. Here the pattern forms in the top and it's bearish reversal pattern. The first candle is a medium long green candle. The second candle opens and closes in the body of the first candle. And the third candle opens with a gap above the second candle and it closes below the first candle low. It closes way below the first candle low. Okay, so this pattern shows a very high selling pressure and it indicates that the trend may end and a reversal is possibly happening. In this case, the second candle is a small. This pattern becomes an extension of a bearish harami pattern. If you don't know about the bearish harami pattern, we saw it in the in the first episode. Just go and check it out with this series of video, the first episode of this series of video. And with this third candle, the possibility of a reversal becomes very strong and significant. So we see here just the same. We see a long green candle and then followed by the second one, which opens and closes the upper body of the first candle, and the next candle is a long green candle which closes, because it's open here, it closes long way below the first candle. So we see that this is a change of a reversal of a price. So we see the price was going up, and after this 3 inside down pattern, we see that there is a change and of a price, and we see that there is a reversal going downwards. 3 outside up pattern. This is a bullish reversal pattern that forms in the bottom following a decline or near support levels. The first candle is a short medium red candle, but whatever the size of the first candle, the second candle is a longer green candle that totally engulfs the first candle. Until now, it is exactly like the bullish engulfing pattern, and it's showing buying pressure and possibility of a reversal. So the third candle opens with a gap below the second candle close. The third candle opens the gap, this gap here, below the second candle close. So this candle open here and close here. So the gap below this second candle close, but the bulls don't allow the bears to take control. So it was like it was going down, but it came up because the bulls didn't allow the price to go down. They took the control and push aggressively out the price up, and the candle closes above the previous candle. So this candle here closes above the previous candle, and this shows a very high buying pressure. Actually, this pattern is an extension of a bullish engulfing, and by having the third candle, it shows higher buying pressure and makes this pattern stronger and more significant than bullish engulfing pattern. The 3 outside down pattern, it is an opposite of the 3 outside up, and it forms in the top. Okay, it's a bearish reversal pattern. The first candle is a short medium green candle, and the second candle is a long red candle and totally engulfs the first candle, and the third candle opens in the body of the second candle and closes below the second candle, which shows we have a considerable increased selling pressure, and the bulls are losing their strength, which gives the possibility that this uptrend may end and a reversal is possibility to open. So this pattern is an extension of a bearish engulfing pattern, and by having the third candle, it shows higher selling pressure and makes this pattern stronger and more significant than the bearish engulfing pattern. If you found value in this video, please like and share. Also comment below which candlestick you want me to cover next, and or which pattern you want me to cover next. Also, do not forget to subscribe and turn on the notification bell for other valuable video tutorials like this. See you in the next video.